So the financial system. It can feel, really complex, maybe even a little intimidating. But when you boil it all down, it's really about a few core ideas. How money gets created, how it moves around the world, and why it's the absolute lifeblood of our global economy. In this explainer, we're going to break it all down for you. All right, let's kick things off with something we can all relate to. Payday. That moment your paycheck hits your bank account, well, you've just connected to this massive global system that links billions of people and trillions of dollars every single day. But have you ever stopped to think about what actually happens to your money from that point on? You see, at its heart, the whole system is basically a giant bridge. It's this incredibly intricate machine designed to solve one simple, fundamental problem. It connects the people who have extra money, we can call them savers, with the people who need money, the borrowers. And that could be anyone from a family buying a home to a company building a new factory. Okay, so to really get a handle on this, we're going to follow the money through 6 key stages. First up, why does this all matter in the first place? Then, where does money actually come from? We'll look at the payment rails that move it and the powerful engine of credit that puts it to work. After that, we'll meet the key players and the rules they follow. And finally, we'll see what happens when the whole system gets a shock. All right, first up, why should you even care about any of this? Well, here's a great way to think about it. If the economy is a living body, then the financial system is its circulatory system. It's constantly pumping capital, the lifeblood, to every single part, keeping it healthy, functioning, and able to grow. And this quote from MIT OpenCourseWare, it just boils it all down perfectly. The entire massive financial market is driven by this one simple, essential relationship. This constant flow between lenders and borrowers is what underpins, well, everything. And that idea leads us to one of the most foundational principles in all of finance, the time value of money. I mean, why would anyone ever lend out their money instead of just stuffing it under a mattress? Simple. Because $1 today is worth more than $1 tomorrow. It has earning potential. You can invest it. And that simple idea is the engine that drives all of finance. And check this out. This is a perfect illustration of just how powerful that principle is. If you took just one single dollar and it grew at 10% a year, in 20 years, it would be worth almost $7. That is the magic of compounding. And the financial system is designed to harness that force on a global scale. Okay, so if money is this powerful thing, where does it even come from? Now, the answer here might actually surprise you. It's not about giant printing presses churning out banknotes. See, most of the money in the world today isn't actually printed. It's created digitally. It all starts with the central bank, which kind of sets the stage. But the real magic happens at commercial banks. When a bank gives someone a loan, say for a car, it doesn't just hand over a briefcase of cash. It creates a brand new deposit in their account. And that new deposit is new money. Okay, so money exists. Now what? Well, it needs to move around. And that brings us to the global payment rails. This is the essential and usually invisible plumbing that gets money from point A to point B, whether you're paying for groceries or a corporation is buying another company. When it comes to trading financial products, things happen in 2 main arenas. On one hand, you've got the public, centralized exchanges. Think of the New York Stock Exchange. Everything there is standardized and pretty transparent. On the other hand, you have the huge over-the-counter, or OTC market. That's where 2 parties make private, customized deals directly with each other. Now, let's take something like a company's stock. It has a pretty cool 2-part life story. It's born in what we call the primary market. This is usually through an initial public offering, or an IPO, when the company sells its shares for the very first time to raise money. After that, the stock lives the rest of its life out on this secondary market, where it's traded back and forth between investors. All right, so we've covered where money comes from and how it gets around. But the really interesting part is, how does it get put to work? This is where we get to the real engine of the system, credit and capital. This is how that money gets channeled to fuel the actual economy, to build things, to fund new ideas, and to drive growth. You can really think of this as 2 main highways for capital. The first highway is an indirect route that goes through banks. They act as middlemen, taking in deposits from all of us savers and then lending that money out. The second highway is much more direct, the capital markets. That's where companies and governments go straight to investors to get the funds they need. And when you're on that capital markets highway, it is absolutely crucial to get the difference between stocks and bonds. It really just boils down to one simple question.
Are you buying a piece of the company, or are you just loaning it money? A stock or equity means you own a small slice of the business. That means more potential for growth, but also more risk. A bond is basically just an IOU. You're making a loan, and in return, you get regular interest payments. It's usually a much safer bet.
And this chart, it shows that risk-reward trade-off perfectly. It's so clear. Look at the left, you've got stocks, which historically have been way more volatile. Their prices can go on a real roller coaster ride. Then on the right, you've got bonds. They're more like the steady workhorse, offering lower returns, sure, but with a much smoother journey.
And it's not just stocks and bonds. There's this whole universe of other financial products out there. You've got raw materials like oil and gold, we call those commodities. You've got complex things called derivatives, which often work like insurance policies against risk. And you have things like asset-backed securities, where loans like mortgages get bundled up and sold. Each one has a specific job to do.
So this huge, complex engine, it doesn't just run itself, right? So who are the players, and what are the rules of the game that are supposed to keep everything on track? Let's meet them. And as you can see here, it's a really complex ecosystem with a ton of different players. You have individuals like us, you have corporations raising money, you have giant asset managers who are investing our retirement funds, and of course you have governments and central banks who are kind of like the referees of the whole game. Now, inside that ecosystem, there are two roles you hear about all the time: dealers and brokers. And they're not the same thing. Dealers or market makers are in it to win it. They use their own cash to buy and sell, taking on risk to keep the market moving. Brokers, on the other hand, are more like matchmakers. They don't risk their own money. They just connect a buyer with a seller and take a small fee for their service. There's this common misconception that everyone in the market is just a speculator, trying to make a quick buck. But honestly, a lot of the big players are actually hedging. They're using financial products like a form of insurance to protect themselves from risks they already face. Think of an airline locking in its future fuel price, or a multinational company protecting itself from a sudden swing in currency values. And watching over this whole system, you've got two main levers that are used to manage the economy. Monetary policy is the central bank's toolkit. They use things like interest rates, and they can act very quickly. Fiscal policy, on the other hand, that's the government's job. They use big tools like taxes and spending. It's got a lot of power, but man, it can be slow to get going. Okay, so this brings us to our final section. And honestly, it's probably the most important one. Why does any of this actually matter to you? How does the health of this abstract-sounding system have a very real direct impact on our everyday lives? The thing about economies is they never, ever grow in a straight line. They move in these natural cycles of booms and busts, expansions and recessions. And the financial system doesn't just reflect those cycles, it can amplify them, making the good times feel amazing, and the bad times, well, so much worse. So why does that happen? It's because the system's greatest strength, how interconnected everything is also its biggest weakness. When something goes wrong, it's like a line of dominoes, A problem in one tiny corner can spread through the entire system with terrifying speed. The 2008 global financial crisis is just a textbook example of this in action. It all started with just one type of bad asset: risky mortgages in the US. Then, those bad mortgages started to infect the bank's balance sheets. From there, the infection spread from bank to bank because they all lend to each other. It went global as these assets were sold to investors everywhere. And finally, confidence just collapsed. Credit, the fuel for the whole economy, froze solid. Okay, so after all of that, what are the big takeaways? What should you remember? First, this whole system isn't just for Wall Street. Its number one job is to get money from savers to borrowers. It does this through a massive network of banks, markets, and all sorts of products. And at the end of the day, its stability is absolutely critical for all of us because it directly hits our wallets, our jobs, and the price of everything we buy. So, we'll leave you with this final thought to chew on. The world of finance is changing at lightning speed. We're talking about everything from crypto to AI. So the big question is, how do we keep all that incredible innovation going while making sure the system stays stable enough for everyone to depend on? Because understanding the system is the first crucial step towards shaping its future.